Ladies and gentlemen, good day, and welcome to the Camlin Fine Sciences Limited Q4 and FY26 earnings conference call. Before we proceed, this conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference call is being recorded. I now hand the conference to Mr. Ashish Dandekar, Chairman and Managing Director, Camlin Fine Sciences Limited. Thank you, and over to you, sir.
Thank you. Ladies and gentlemen, welcome to the quarter's earnings call. We know your time is precious, so we will immediately begin the relevant portion. You will note amongst all the noise that is happening around the world that we have been on a very consistent strategy implementation for the last 2 years, 3 years, and you'll see the progress in the numbers and in explanations. So without anything more, I'll hand over to Santosh Parab for his brief.
Thanks, Ashish. Good evening, everybody, and thanks for attending our earnings call. I'll just start with the brief on what is happening around the world. Everybody knows, but there has been some impact on our business in this quarter. This quarter, the sale was impacted by around 20% due to delay in shipments, lack of ships, and increased voyage time to our markets across the globe. This conflict also has affected the availability and prices of some of our raw materials. The longer delivery time has also impacted our working capital cycles, and that paucity of working capital cycle has also percolated in some ways on the pushing of our business and growing of our business in some of the geographies. With this, we clocked around 424 crores of revenue in this year. The total revenue is 1,723. You have to note that we have some disclosures on discontinued operation, on which I will talk later, which have been shifted from the total revenues to a discontinued business. Hence, the 9-month revenue and as well as last year's revenue is looking like it has reduced, but it is a disclosure. The revenues have been made in this quarter also. We had 7 to 8 crores of revenue, which had to be shown as discontinued business. And the total revenue of 1,723 is also lower by around 54 crores. I'll now come to the segments, our segments. The straits business, we have been able to hold on to our market share. However, due to local competition and pricing pressures, the revenue from straits has reduced a bit. Of course, it was also helped by increase in the dollar prices, but the local competition has impacted us, straits. Having said that, we changed our strategy of trying to use more of these straits for making blends rather than competing it with the local Indian competitors. We have been trying to blend this straits into blends business, and hence some of the straight sales business has moved to the blends business. In blends, we have shown that has been the hallmark of our revenue in last few years, and we have maintained a steady growth. We have been saying that we will be doing around 20%. We have clocked 17%. If we add the discontinued business of blends business of Europe, we would have grown by 18%. We missed the target of 20% primarily because the projections of WinPi, which did 10 crores in the first month, was only able to do around 17 crores in the last 3 months. As I said, the working capital cycles and the liquidity crunch has impacted their business. But we are confident that it will come and it will give the results which we have been talking about in WinPi. Going forward also, blend business is looking good. I will tell you about it after some time. The vanillin aroma portion, we had told you last time that we have changed to the ethyl vanillin campaign, and we stopped the production of methyl vanillin, and we were not modification, but changing over our methyl plant into ethyl vanillin plant, which took around 2 months. And then we started ethyl vanillin plant. So largely methyl vanillin, there was very small portion of methyl vanillin produced in the quarter 4. It's around 110 metric tons. But we did have internal channel stocks. We had sold and we were holding into some inventories in US, especially looking at the tariff going down. We had delayed some of the inventories and hold those inventories to reduce the tariff impact. So internal channel stock, the entire sale of vanillin which is being happening in Q4 is largely to the internal channel stock which will be liquidated. We also have some internal channel stock still remaining of methyl vanillin, which will help us in the coming quarters. Of course, with ethyl vanillin, we have orders on hand for the quarter 1 of around 300 metric tons. The plant is running well. We will be taking a campaign of around 600 metric ton of ethyl vanillin. So we have enough methyl vanillin to, not enough, but a fairly good stock of methyl vanillin to not allow the market to die. Of course, and the tariff withdrawn, there would be higher realizations. We have started looking the green shoots on that. We did the channel stock was sold in the last month, and our average realization for the company for the vanillin had gone up from sub 11 to more than $12.5 in quarter 4, and we are quite confident it will grow obviously above because of no tariffs there. Only 15% tariff is there in US and Europe. This higher realization will also benefit us in the next quarter. You would have seen that we also had lodged a claim after the withdrawal of tariff by the Supreme Court order. We had paid around 9 crores of duty through the customs till February, which we have applied for the claim, and that has reduced our cost because the payment of duty was considered cost of goods sold, which we have now reduced. We are confident that this claim will be received. These have been lodged and accepted by the authorities. If you see, the overall cost also remain under control. As far as employee cost is concerned, we have been saying that we will be investing in human capital to help us grow the business, especially in the blend sector, and we are really looking at exponential growth in blends business. Hence, last 2 years, if you see, we have been investing into employee cost, and that's one of the main reason in increase in employee cost. Of course, WinPi also came for 4 months. This entire quarter results also incurred revenues and expenses of WinPi for the whole quarter. Last quarter it was only 1 month. That has also pushed the cost. Overall cost also are under control, but for the freight cost which has increased in the last 6 months and some of the other costs. But WinPi also has contributed to increase in that cost. Resultantly, the quarter EBITDA has been 21 crores. It's 5%. I think in the given circumstances, it's not a bad performance. Obviously, going forward, the currency fluctuations will impact the business, but for us, we being sales in dollars, it should positively impact and it may increase our revenues to such extent that we would be able to absorb the increase in the cost of the raw materials. Of course, may not be entirely, but there will be, we can recover the cost. This quarter, we also, liquidation of CFS Europe happened. We received the order, liquidated an order, and the accounting entries has been done. There is a gain booked on loss of the company, which is around 100 odd crores, which we have booked this quarter. One good thing about it is the cash burn on this discontinued operations of around 50-60 crores every year is going to come to zero from next quarter, and that's a big cost saving. China still remains under liquidation, but we don't think the cost will be more than 7 to 8 crores next year. Just quickly on the outlook for the next year or the subsequent quarters, vanillin business, as I said, will improve its realization. Volumes are also likely to increase, but yes, we have to see the lingering conflict situation, how it acts. Blends, again, as I said, we have invested into the human capital. We are already have the pole position to now push the blends for higher growth. In the first month itself, we have crossed more than 100 crores of global blends business, and that run rate is taken. You can just see the kind of growth we are looking at blends. Obviously, we have also, last Friday, we had an unfortunate incident, though it was not a fire at the Dahej plant. Fortunately, because of our responses in quick and safety measures in there, the fire didn't spread to all the plant. We were able to contain it. There will be some loss, but we have adequate insurance for it. In fact, we had reduced or planning to close down the plant, shut down the plant of diphenol, especially with the price. As you know, our basic raw material price is 85 rupees, is now being quoted at more than 150 rupees per kg, and the availability is also not consistent. So at present, we are getting it, but we are not sure if the conflict lingers, how it will look like. So we had taken a conscious decision that we should reduce the cash burn because of the high pricing and lower realization in catechol. We had already secured hydroquinone from China, which is at a very reasonable rate, and we would save by purchase rather than manufacture, which helps us to keep our downstream of states running. Catechol, we already have enough stock because the plants were running at 60-70% last year, and it was not matching the consumption was not enough for the vanillin, and hence we have enough stocks in the system of catechol which can sustain 8 to 9 months of our vanillin production. So having said that, things look good. We will be looking at how to use or repurpose this diphenol plant. We have to also look at how the prices move, what would be the raw material prices of diphenols, how the competition is looking at it, how the Chinese are responding to the whole situation, and also the conflict. And soon we'll take some decision and decide on the path for the diphenol plant. Having said this, I think I'll open this forum for questions.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants, you are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A reminder to all, you may press star and one to ask a question. We will take the first question from the line of Raman KV from Sequent Investments. Please go ahead.
Hello, sir. I just have some doubts. One is with respect to diphenol prices, which you said have increased drastically from 85 to 150. This is a raw material for production of what, actually? Hello, can you hear me?
Yeah. So diphenol is the product which we manufacture. Diphenol is nothing but hydroquinone and catechol. I was talking about the raw material phenol, which was generally 85 rupees for last, just before the conflict. Now it has gone up to 150. So naturally, the cost of production of our product, hydroquinone and catechol, have drastically increased.
Okay, understood. And catechol we are manufacturing internally, and hydroquinone we are supplying it from China, right?
We manufacture hydroquinone and catechol together as diphenols.
Okay.
If we stop the diphenol plant, both of the products cannot be manufactured. I was saying that hydroquinone we use entirely for our states production, value adding it. That hydroquinone we will be importing. As far as catechol is concerned, because vanillin plant has not achieved enough capacity utilization last year, we are carrying enough catechol, which can help us to produce vanillin for next 8 to 9 months. And that catechol we will not be importing. We will be importing hydroquinone for our downstreams. And that hydroquinone we have already secured from Chinese manufacturers for next quarter.
Okay, understood, sir. So basically, we don't have any impact of any direct impact of this sudden rise of phenol prices, if my understanding is right.
So yes, we are trying to make or buy. It's a simple thing. It's better to buy now the raw material than making it at higher cost. So you're right in that sense. And we are buying hydroquinone so that our real downstream sales of states and vanillin, we are able to keep that sale and at a reasonable margin than producing it at present.
Okay, sir. And one from the PPT, obviously from the report result and the PPT, I can see that we have 85 crores gain from discontinued operation. Can you just elaborate what is this?
So as you know, I just mentioned that we have this CFS Europe subsidiary which was liquidated, and there were certain loans in that subsidiary which has been booked as a gain on de-recognition of CFS Europe, and that's what has come. It's around 95 crores of loan, but the credit is lower because there are some discontinued business and the losses therein, which have been adequately explained in the notes. So that this discontinued business, the credit is largely on account of the loans which are what de-recognized from the financial statements on liquidation of CFS.
Okay, understood. And so, with respect to vanillin, you have mentioned that the internal channel stock of vanillin has been liquidated at the end of Q4. So now can we expect our realization to move upwards, given that the inventory has been liquidated at the same time the US tariff has reduced from 50% to 25%?
So as I started with saying that we had taken a campaign of ethyl vanillin. We have two vanillins, methyl and ethyl. Till now we were producing methyl and selling methyl. We had a good order book of ethyl vanillin, and hence we wanted to produce ethyl vanillin. For that purpose, we had to take a break of methyl vanillin. We stopped the production of methyl vanillin from 15th of January. So there was hardly any production here, but we have sale of vanillin. And that sale of vanillin is from the internal channel stocks, in the sense the material which we had sold to US to our subsidiary was carrying the stock. So that channel stock has been sold in this quarter, and that's why you can see the revenue. And still we are carrying internal channel stocks which will be sold in the subsequent quarter. And we'll also be selling ethyl vanillin, which the campaign has started and the production we have got from April. So in April, in the Q1 quarter, we'll be selling ethyl vanillin, which we are producing now, and we'll be selling some channel stocks, internal channel stocks of methyl vanillin. Now, coming down to prices, you had that last I'll answer that last part. Yes, the tariffs have gone down. Naturally, we were impacted. The basic prices in US have not moved. They're 17.5, $18 in US. Because the duty was at our cost, we had to sell from India at $11, $12. Now, duty reduced, our realizations will increase. In fact, as I said, our realization moved from $11 in the last quarter to almost $12.5 plus in this quarter. And naturally, the realizations are better. Realizations will increase in the next quarter.
So just a follow-up on this. Is there any realization difference from when we compare methyl vanillin to ethyl vanillin? I just want to understand the rationale behind switching from methyl vanillin to ethyl vanillin.
Generally, methyl and ethyl, the customers like to have ethyl is a more stronger note product. So its consumption is lesser than methyl vanillin. But the customers ask for ethyl vanillin also, and they're happy if the supplier is able to sell both the vanillins. Now, having said that, this ethyl vanilin's price difference generally is $1 to $1.5 more than methyl vanillin. But our cost is also almost $1 more. So either I sell methyl or ethyl, my realizations, the margins per kg remain the same.
Understood, sir. Understood. Thank you, sir.
Thank you. We will take the next question from the line of Rushikesh Shah from Alchemy Capital. Please go ahead.
Yeah. Am I audible?
Yes.
Yeah. Thank you for taking my question. Sir, I wanted to know what would be our vanillin sales this quarter?
In quantities or value?
In quantity.
In quantity, vanillin we sold quarter around 320 times.
325. Sir, if I remember correctly, in Q3 you had mentioned that we had 200 tons of vanillin which we had held back. So I thought this quarter we might see a better volume sales. So what would be the reason for only 325 crores? I know that we had to hold off our production, but still we had 650 crores in 650 tons in our channel with subsidiaries and everywhere. So I think our volumes would have been better, right?
So I'll just put the same numbers which you said. We talked last in February. By that we had done 100 tons. We said that we'll be doing 200 more tons by holding back the stock and trying to take the benefit of realization at 300. And as I said, I'm still carrying around 300 tons of vanillin stock in the channel to sell in quarter one. That's how it's 600 works out.
Right. Okay. So, okay, got it. So my second question was, if we look at our profitability, how much of an impact would you say this Middle East crisis had on our EBITDA? See, because if I remove the 10 crores or 12 crores of tariff rebate that we have got, then EBITDA would have been around 10 crores. So it is only 2.5% EBITDA margin. FY27 we have guided for double digit. So what do you think? Would there be any change to our guidance, revenue wise and margin wise?
So
I'll explain to you. The Middle East crisis has impacted our sales by about 50 crores or so, as well as Santosh mentioned earlier in his opening remarks, that the Vinpai acquisition, there was an EBITDA loss, a loss at EBITDA level of 10 crores. It was due to some liquidity issues, which Vinpai had, which of course we are addressing. So if you combine these two, our EBITDA should have been higher by about 30 crores.
Okay. And
We are not changing our guidance, and we are not changing our guidance for FY27. We are guiding on the same line.
right. And sir, this right now, see, now, let's say our tariffs are down to 18%, and we are able to sell it at $18. E-file would be at $20 or something. So what would be our blended realization we can take for FY27?
So I think it will be around in the range of $13.5 to $14.
Okay. And I have one more question on the blend side. So blend and Vitafor, what would be the EBITDA break-even we can expect? At what revenue run rate?
Yeah. So Vitafor is at 16 million for the whole year, and so is Vinpai is also at the same level, 14 to 16 million.
Okay. Okay. Thanks. I will come back if I have any other questions. Thanks a lot.
Sure.
Thank you. We will take the next question from the line of Avnish Tiwari from Vicario. Please go ahead.
Hi. Can you explain or help us understand your debt levels at March 26 and how you plan to manage your cash flow in fiscal 27 in terms of how much you expect from operations and any other sources to meet your debt payments and working capital requirements as you're growing the business again in 27?
So last year we started with around 620 crores of debt. Our business was increasing. We did take some debt in India of around 45 crores on working capital, which is an increase. If you have seen, we have also borrowed 30 crores for our Vinpai open offer. We borrowed at the year end. On a global basis, Vinpai was added to the whole kitty this year. It was acquired. It had around 6.5 million of loans in its books, so that was 60 crores orders increased because of that loan. But however, the increase in the total loan is only by 50 crores because we knocked out around 85 crores of Italian loans. So at the end of this year, we have around our 670 crores loan. Out of that, we are carrying 30 crores in escrow, which is for the Vinpai open offer. Having said that, this 670 crores, the overall repayment for the whole year on a consolidated basis, around 60 to 70 crores. We think that it could be managed. There will be some stress on if our turnovers increase at a faster rate. We will require additional liquidity and additional support. We are looking at some kind of an support from the market on debt for the growth as well as stabilizing the current business and have some cash to tide over this conflict situation. It's better to have some cash because there could be longevity of the working capital if the conflict lingers.
Right. So are you looking at some degree of capital infusion just to make it even more resilient so that you can pursue your growth plan independently?
Capital infusion is the last resort. We are in the market for debt at this moment, so that looks like a better option. But we know that the times are difficult, and that's why we have kept that door open, and you have seen that we have increased our authorized capital to some extent in the month of March. But at this moment, we are the equity infusion is really a last resort, not on the table at all.
And is debt you're looking at, this is a simple plain bank debt, or this is more structured or a bit of a high yield debt of between equity and debt
We
kind
are
of approach?
looking in a combo, because we have large now a network of our companies all over the place. So looking at the nature of that, if you see in India, I'll go for a structured debt. So for example, if I borrow in Mexico, it will be more of a bank debt. So we will be looking at a combo. We have kept all doors open. As you know, the times are difficult, especially to have cash from the market, right, in that situation. So largely structured in this situation, but we are also looking at the bank finance.
And do we have some sort of a sense or range what cost it would come at?
It's very difficult now because it will be assessed. The guy who gives structure finance is going to assess my risk, but we will try to keep it as minimum as possible as the market rates.
Got it. Second question I had in the industry cycle, you were talking about inventories in the channels reducing in US, and then maybe getting your volumes back in US. How is that situation? When do you think you can get your volumes strongly going in US?
This is for the vanillin business?
Yeah, vanillin business, yeah.
Yeah. So vanillin business this year, as we've said in the past, our estimate for FY27 in the US will be around the 2,200 to 2,400 metric tons. And we are on stream to achieve that number. That's both methyl and ethyl together. So we have several businesses already contracted and some being contracted. So I think that 22 to 2,400 is what we are looking at for this year.
Will it be more coming in second half, or even Q1, Q2 can also see a strong pickup? Because in Q4 was just 300 plus tons.
Yeah. So Q1 also will show some pickup in the US, but the total combined between US and Europe, Q1 will show some growth over Q4 of last year of FY26.
Got it. And then it will keep picking up to meet your guidance.
Yes, correct. That's right. Yeah.
Thank you. Thank you.
Yeah.
Thank you. We will take the next question from the line of Rehan from Coherent Wealth. Please go ahead.
Hi, thank you for the opportunity. I had a couple of questions across the business. What is the tonnage or catechol inventory we are sitting on in terms of for now?
So it's about in the region of about 3,000 tons.
So that in terms of vanillin yield is how much approximately between methyl and ethyl? Because I know the yield would be different because of catechol. Sorry?
Yeah. So it's about 1:1. Roughly for a calculation, you can take 1:1 for both, for methyl and ethyl.
Okay, and considering our guidance for FY27 has been about 70% utilization, so that would be about 4,000 to 4,200 tons of vanillin. Where would the balance 1,000 come from?
So we buy from China.
So you will buy catechol from China?
Yeah, either catechol or glycol.
Okay, and then you will blend it here and do the needful.
Yeah, then we'll do it here. Yeah, then the final step, whatever the vanillin manufacturing is done.
Understood. And the tariff currently, as per my understanding, is 10%, not 18%, right? Because of
it's 15%. There's a base, so there's a base 5.5% duty, and then there's 10% tariff across the board. So it's 15.5.
So your current realization would be about $16 odd in US at the moment?
No, I know, because the DDP pricing today in the US market, our competitor Scienco is selling at about $17 to $18. So there is a holding cost. There's a holding cost and the tariff cost and some channel financing costs. So all of that gives us net realization would probably be in the region of about $13.
But I think a couple of quarters back, we had seen prices signed at $19.5.
Correct. Yeah. So, but Scienco is trying to saturate the market. I mean, get the Chinese out of the market completely. And they've taken this position of pricing, and we can't price higher than them. So we kind of maintain pricing along with them. But I think in the next quarters, they have no choice but to increase the price, and that's what we are thinking, that they would look at increasing the prices to the $19 to $20 region.
So your pricing for Q1 as on blended across Europe and US, realization would be about, like in hand post tariff will be about closer to 14?
Yeah, 13.5, 14, in that range.
Okay. And is there, because it's been almost a year since, the ADD came in, are we now seeing that now is the channel clear? Because prices should have been north of $20 by now, excluding Science Co. Even them, I'm wondering how is with this inflationary scenario.
Yeah, it's surprising what they're doing, but I think we expect them to change their position in the next couple of months. Yeah. They will increase it because they've kind of, their capacity utilization would be at 100% by then. So they naturally they'll have to increase the prices. Yeah.
And the cost currently that the company is incurring because of employees, is this as we had discussed earlier in the February Concall as well, this is the peak, right? Now we will let the business stabilize a bit because you've done 2 acquisitions, you have a new facility coming on stream, which is abandoned. So now is this the peak hiring? We're not seeing more increased employee expenses on the P&L?
Yeah. No. So I don't think there will be significant changes. It will be in this region.
So then considering you moving from from manufacturing to, importing and then doing your value addition here with vanillin scaling up and blends in its nature is already asset light, are you on track to deliver about 330 crores of EBITDA for FY27? Because vanillin alone at your current realizations of 13.5, 14 should give you 200 crores of EBITDA.
Yeah. So the way we are seeing it is that on the top line, we should be in the region of between 22 to 2,400. Mm-hmm. And EBITDA margin would be between 12 to 14% on overall basis. So that's the swing. Of course, we do have a plant which we are trying to look at what to do with to make it into multi-purpose and see if we can reduce some of the costs on our raw materials as well. So there are different programs which we are working on. That's why the range would be between 12 to 14% in terms of EBITDA. And top line also would be in this range of 22 to 2,400.
So going forward, we don't have any European losses. The Chinese losses, I think, are about 8 crores odd annually, right? Which is about 2 crores a quarter. And considering you have about 300 tons of stock in vanillin plus a 600 metric ton campaign. So are we moving back to double-digit margins in Q1 onwards at least? Because Q4 we expected some sequential performance, but I think we've slipped further because of the geopolitical tension.
Geopolitical. Correct. So Q1 is difficult to say that whether because we did have manufacturing of diphenol till the 22nd of May, when we discontinued, and we started getting material from China, which now we are consuming. So the full impact of that will really come in Q2. So,
but you would also have phenol inventory, right, which would give you some inventory gain.
No. Phenol we don't have any inventory because it's just in time because it's next door of the Deepak Phenolics plant. So we don't keep any stock. We just keep it's just in time supply from them.
So are we in Q1? Are we going to maintain these 48% gross margins, or are we going to slip down? Because if you're going to do 4,000 tons of vanillin,
I think we'll maintain that margin. There could be 1% up or down, but we should be able to maintain that margin. Yeah.
Because at 700 tons of vanillin alone, not 700, at 1,000 tons of vanillin, even if I take it as a quarterly phenomena, I know it's not that way, but if you have to even average it out, so then just for simplicity, that alone should give you back to your old numbers, right? At 13.5, with this current rupee depreciation, even if your cost of manufacturing is $9.5 all inclusive, you're at 360 rupees a kg. At 1,000 tons, that's automatically 36, 37 crores of EBITDA. So, I mean, I'm just not understanding the numbers. If you can help me understand the same.
No. So again, the raw material costs have gone up, right? The $9 is no longer $9 because phenol costs and all other raw material costs have gone up in the current situation that we are seeing. So that 9.5 assumption was prior to the war. After that, of course, with all these cost increases, your realization has not gone up, but your cost has gone up for vanillin. So when I look at vanillin, I would say you bake in about,
But this catechol is old inventory, right? As Santosh sir also mentioned, that 3,000 tons is not come now.
Catechol is only a quarter of the raw materials. There are other raw materials as well. So, for example, glycolic acid, caustic. Caustic is actually equal in value as catechol is, and that has gone up by literally doubled up in the last after the war situation.
The total cost of raw material cost itself is 7.5 pre-war, with around $2 of catechol in there. So you can just imagine there are a lot of other raw materials which are going, which can really get impacted by this geopolitical situation.
So today, what is your, at current pricing, even what is your cost to make at 4,000 tons, what will be your per kg cost of vanillin?
So my raw material cost, even if we hold on to the catechol and we are seeing that around 20 to 25% increase in cost. So if I knock out $2 to $1.5 from my total cost of 7.5 percent, 5.5 plus 20%, that's how boss was saying $9.
So today is it $10 or 9.5?
Sorry to interrupt in between.
This is on the same, madam. No, Santoshji, what is the current cost of per kg of vanillin at these levels?
Yes, so that's what I'm saying. So the raw material cost, which was $7.5, has gone up by at least $1.20. So it's almost $9 is the raw RMC. Plus your conversion cost at 4,000 tons, if you were to look at your conversion cost, it would be at $1.5. So you're at $10.5 of base cost. And your realization is 13.5. So you're talking about $3 spread. On a 800-ton in the first quarter, you're looking at 23 crores coming from. They're not 35, 36, what you're making in.
Sorry to interrupt in between. Rehan, I would request you to please rejoin the queue again for more questions, as we have participants waiting in the queue. Thank you. We will take the next question from the line of Surya Patra from Phillip Capital. Please go ahead.
Yeah, thank you for this opportunity. Sir, my first question on the let's say the base business, PBHQ, BHA, and all those kind of things. So the kind of price pressure, competition, also the kind of recent in general rise in chemicals prices because of the war situation what we have seen. Given those backgrounds, what is the kind of outlook that you would be having on that? The straight specialty ingredients as well as the specialty, the states business.
So in the states business, some of the cost increases we will be able to pass on, and we are passing on. TBHQ prices have corrected and have gone up to reflect that. BHA pricing also is slightly better than it was pre-war. So in terms of passing on the increase of costs, with a lag, we are in track to be able to pass it on. So I don't see a problem with that. As far as volume is concerned, I think we are gaining a lot of market share also in the blends business, where our TBHQ and BHA consumption, internal consumption is growing, which also is giving us some economies of scale in terms of production of TBHQ and BHA.
So whether the outlook for 27 it would be positive, or how should one really think so?
For TBH to BHA, it is positive. Yes. For TBH to BHA, it is positive, the outlook.
And from the performance chemical point of view, it would be?
Yeah, we don't have much of performance chemicals. We don't have much now. And now, with catechol, after stopping the diphenol production, the performance chemicals will be a very small part. They're not selling, we were making hydroquinone and selling some hydroquinone also in the market. So slowly all of that will go. So we are not really, the focus is not on that.
Okay. Now, second question is on the supply chain issue practically that you would be seeing currently. There was a obviously difficult situation. Whether the worst is behind now and Q1 onwards, should we see a kind of improved supply situation for us, or there would be some challenges relating to some particular input? If you can highlight that. And
see, the problem is, as you know, in the supply chain, the bigger problem is logistics, and that is very, very unpredictable, because what looks like 20-day shipments are taking sometimes 40 days to come or 50 days to come. So that uncertainty till this geopolitical situation settles down will remain, and very difficult to predict whether that will very quickly correct or it will take maybe a few months to correct.
So there the overhang remains, because even if the situation is, I don't think the logistic guys will immediately come down. In fact, tomorrow morning I am meeting one of our guys, V-Trans, who is a big logistic guy. He's coming, and I know why he's coming. He wants to increase the price. The cost, if you compare pre-war and now, in fact, pre-war also the costs were increasing of freight. The cost, as far as we are concerned, where we put almost a lot of material across the globe in the American continent, both north and south of it, the costs are almost 3 times. And yes, you can always say why it's not here, but it doesn't work like that, So I don't think even if tomorrow the war stops, this thing is going to get unwound in a day or a week. We feel that this will linger on for some time. At least it will take a quarter to come back to the normal situation.
So then, H1 of FY27 is a continued impacted period for the business generally, theoretically. That is what one should believe, right, sir?
So how this pans out on cost basis, I feel that the cost of freight may remain high. If even if the war is over and the crude remains at 100, then there's no respite, right, for the feedstock. So it's very unpredictable. The question is, if the crude is 100, how much I can pass it on to my customer, right? And how much I may have to bear from that. So it's a very difficult calculation to say. I feel that even a stable growth of 10 to 15% over these 2 quarters is great. Really great.
Okay. Sir, about vanilla business, you have talked about it already. So since the US tariff was not there, or almost a near normal kind of tariff situation that has been there in some time, and and this is a kind of a year-end situation, and normally the order book build-ups is a time also. So any order book build-up that you have seen for FY27, and hence that confidence that, okay, the certain quantum of the supply that is definitely possible, irrespective of the pricing or the cost equation. And also, yes, sir.
Yeah. So to answer that, we started with the ethyl vanillin campaign, and the campaign is for 600 tons, and we already have an order book covering 50% of that. And the campaign is we'll have to maintain stocks also, because we can't be out of the market once we change back to methyl vanillin. So I think in terms of demand, what we were saying between, around that 4,000 ton mark, I think is very, very doable.
Okay.
Our bigger challenge is, of course, the longer working capital cycles and logistics and cash flow. So that's what we need to address, because we have a large order book even in our all our businesses actually, and executing that with tight cash flow positions is a bigger challenge than the market itself.
Okay. And if you can also just add upon to the kind of your outlook about vanilla for the European market. So, what inventory situation now? Do you see some easing situation in the Europe at least?
Europe, the market situation is much better. In the ethyl vanillin also, out of the 300, 150 is coming from Europe. And methyl vanillin, we have no stocks to give to the European market till we start our campaign again. So the market is coming back. So, I mean, what we had said, that 1,500, 1,600 tons for the year, I think we're good for that.
Okay. Just last one point from my side. About the Vinpai and the Vita4 ramp-up. So we have been trying to build up the field force for scaling up those operations, which was almost like stalled before acquisition. So what is the field force addition practically now we have created during FY26, and whatever the exit rate revenue that we have seen for both these two businesses. So what is the kind of scale up that we should see in the blends operation?
So in the blends operation, we closed the year at 1,050
including discontinued.
1,050 including discontinued. This year we are looking at anything northward 1,400 crores for the FY27 in the blends business. So as far as adding sales force, it is across the world. So it's not only for Vinpai or in Vinpai or Vita4. We've also added workforce because the markets are in different places, right? So the sales people are being added across the world, and that addition we have done, which will support Vita4 and Vinpai growth. We expect Vinpai and Vita4 to be, above break-even EBITDA in FY27 for sure. And the overall blends business to be northwards of 1,400 crores.
Sure. Just one point, sir. This tariff refund that you have mentioned from the US, so whether that would be really tangible or it would be adjusted subsequent to trade?
That's what we understand is normally it becomes 50-50.
So historically it has been 50-50, but the US government and the people there, all the consultants are saying that we may get the cash upfront. But historically, if you see similar situation, they have given 50% as cash and 50% has been adjusted against duty. But the kind of turnover we have in from India, vanillin itself, that 9 crores, 10 crores, we can swallow it in couple of 3-4 months. So we are not worried about that. If they give cash, we are more than happy. If they give duty refund, still we are happy.
Okay, sure. Yeah, thank you, sir. Wish you all the best.
Thank you.
Thank you very much. Ladies and gentlemen, due to time constraint, we will take that as the last question for today. I now hand the conference back to the management for the closing comments. Thank you, and over to you, sir.
Thank you. Thank you for your precious time, ladies and gentlemen, and we look forward to interacting with you in the next quarter. Thank you.
Thank you, members of the management. On behalf of Camlin Fine Sciences Limited, we conclude this conference. Thank you all for joining with us today, and you may now disconnect your lines. Thank you.